and welcome to part 2 of Modern Business Accounting Principles. Now remember, this book is copyright 1936 from the Alexander Hamilton Institute. So take that into consideration if I read you any advice. Today we're going to dig into chapters 2, 3 and 4, development of the account, single and double entry contrasted, and analysis of business transactions. These chapters do get to be quite technical, so I've tried to skip over those parts and just pick out some of the highlights that I think are still relevant in 2019. So let's dig in. The ultimate objective of accounting procedure is to show, in summary form, the result of the many transactions and forces affecting the business. So that's what accounting's for, to show what is happening. To do this requires an organized system for classifying the transactions in a convenient way. And I'd suggest that's not the definition most people would have for accounting. It's not seen as convenient, but it is organized and systematic. There is nothing mysterious about this process, although many people are disturbed by what appears to them to be a most complicated maze of records. I think that's probably what most people associate with accounting. But it is the mass of data caused by the volume of business transacted, which must be entered into the proper records, that gives the impression of complexity in the system. It's just an impression, it's really not that complicated. Thanks, Alexander. Underlying every system, there is a certain orderliness of method which is the same, no matter whether there are 50 transactions or 5,000 transactions. And it is the purpose of this text to explain the fundamental concepts that guide all systems regardless of size. And I would say that is still true. The principles are the same, the systems are the same fundamentally, but they serve a lot of different purposes, and the systems you choose should depend on the size of your business. Small business accounting software is perfect for small businesses, but it really wouldn't work for a large organization that wants to track things at department size, department level, wants to be able to do internal transfers and track internal intangible assets, for example. That really wouldn't work in a package designed for small businesses. The system fundamentals the same, the level of complexity available quite different. Now, this second section is something I see a lot of small business owners struggle with. For accounting purposes, we may look upon a business as a personage in itself. It is this person who owns the assets and owes the liabilities. A business is separate to the owner, one of the fundamental principles of accounting. So you really need to separate it, treat it as its own person, get it its own accounts, make sure you're using a single paper. These are really important to make your life easier. There's no point having to go through all your personal bank transactions if you could have all your business transactions just in one place. It is more complicated because in Australia, as a sole trader, you and the business are the same, but you really do have to treat it like a separate individual. And it's the difference between total assets and total liabilities that constitute the capital of the proprietor in the business. And if you separate it as a person, that makes much more sense. So within the business has assets and it has liabilities. The difference between those is what the owner's part of the business is. If you think of it all as one, it's much harder to make that distinction between what's the owner's and what belongs to the business. All transactions should be viewed from the standpoint of the business whose books are being kept. So for example, if you work in a business-to-business relationship, what's an asset to one business could actually be a liability in another business. If you agree to payment terms of 30 days, for 30 days one business has an asset and another business has a liability. So you've got to remember, you always do it from the perspective of the business for which you are accounting. We then go through some of the technical debits and credits, of accounting, which I will spare you the details, and into chapter 3, where we get to the rules. Now, there is another fundamental rule of accounting that is important to understand, and this is based on the debits and credits system. Now, with software, you really don't need that much understanding of debits and credits. And the time you'll mainly see it is if you ever open a trial balance. Debits, credits, you will see them side by side in your trial balance. And the rule is that for every recorded transaction, the debit entries must equal the credit entries. So if you open a trial balance, you'll find the two totals are the same, or they certainly should be the same. Because accounting is based on the fundamental equation that assets minus liabilities equal capital. So the difference between what your business owns and what your business owes is the capital, the owner's portion of the business. Now, specifically, a balance sheet is not an account. Instead, it's a classified summary of the ledger accounts which appear in a set of books. This helps to show the profit or loss for a financial period that has been ascertained and either added or subtracted from the proprietor's capital. So, balance sheet is one of the most important reports for a business owner, but for a lot of small business owners where their assets are really very small, a balance sheet isn't a fundamental report. You'll find that if your equipment is under the $20,000 threshold, you often just put that through as expenses and you really don't build up assets. You don't own buildings, you don't own intellectual property, you don't have huge amounts of accounts receivable. So balance sheets really, for a very small business, for a sole trader, hit and miss. But they do show you what your capital is, what your owner's equity in the business is. That was really all I wanted to point out from chapter 4, so let's jump into chapter 5. The accounts of a concern are kept primarily for the purpose of recording the changes in the financial condition and determining the causes of such changes. So if you think about that as an accountant, what we're trying to do with accounting and bookkeeping is to see the financial changes and to see what caused those financial changes. It's really not that useful to know that cash went up by $500 if we can't see why cash went up by $500. Was that we made a sale, a new sale? Was that we received money for an old sale? Was that we sold some equipment? If you can't see the reason, it's really hard to dig into what's happening. And it's important because the most important interest in the business is that of the owner. And it is by the capital account and profit and loss accounts that the extent of gains or losses in financial solvency are measured. So this is saying that your profit and loss statement, or income statement as we call them, measures the solvency of your business. And by solvency, we mean how well placed you are to be able to deal with your liabilities. If the records indicate a constantly growing balance in the capital account, the condition of the enterprise is considered to be improving. That's fairly straightforward. If you're making money, you're doing a good job. If, on the other hand, the balance shows a tendency to decrease, the solvency of the concern becomes endangered. If you're consistently making a loss, you really should be evaluating your business. And as it suggests, all the efforts of management should be directed towards the problem of increasing the margin of safety shown in the profit and loss account. So it's important to see changes because when a business is first started, the proprietor owns all the assets unless a liability was incurred at the opening transaction. And therefore, all subsequent business transactions are incurred have an impact on that owner's equity. And all the transactions are incurred with the intention of realizing some benefit that will reflect in an increase in owner's equity. Assets are acquired and disposed of, liabilities are incurred and paid off, services are purchased, and products or services are sold. These transactions may be very simple or extremely complicated, but in every case, the ultimate objective is profit. Profit, that's why we're in business. And if you're not in business to make a profit, then are you actually in business, or do you have a hobby? It's clearly different if you're a charity or a not-for-profit, but if you're a sole trader and you're not intending to make a profit, then you actually fail one of the tests for the ATO being in business. Now, the last thing I want to read goes a little bit away from bookkeeping. There are two phases to every transaction. First, there is the fixing of the valuation upon the commodity or service which a business delivers. So that's pricing. Book's starting to talk about pricing. So it's not just talking about bookkeeping, but things beyond bookkeeping. Second, there is the valuation upon the particular things it receives. So what were the costs of products? What were the costs of services? The merchant, for example, establishes a price at which she expects to sell her goods. This figure is seldom, if ever, the cost of the goods to her, but it is one which will reimburse her for the costs and leave her something over as a profit. Pricing for profit gets even better. The element of profit is realized to cover the particular service which she performs in fulfilling her function as a merchant. Merchants have expenses too. In this case, she delivers goods equal to the cost price plus her services and receives in exchange cash equal to the sum of the two. The purchaser, on the other hand, of the goods receives goods equal in value to the selling price and disposes of cash in exchange. So we then start talking about profit, and it doesn't really go into much detail in this chapter. But don't forget, you've got to cover the cost of creating the product or service you sell. So in products, that might be cost of purchasing products or cost of producing products. In services, that is obviously the cost of your time or a service provider's time in providing that service. But then we have to start covering our other costs, so indirect costs, marketing, administration, sales costs, rent, business overheads. We have to cover those costs as well. And then we also need to cover profit so that we increase our owner's equity, because that's the purpose of the business, and that we have money to be able to invest back in the business if we need it. So that was today's chapters, and I'll see you for the next chapter.